Hello everyone, Rahul Shah here, trying to make investing accessible and profitable for the average investor. A friend sent me a WhatsApp message a day after Zomato announced its December quarter results. It had views of reputed brokerage houses on the stock. Now, apart from one brokerage house, all the others either had an outperform or a buy rating on the stock of Zomato. Now, knowing that I research stocks for a living, my friend could not resist asking my own view on Zomato. Well, I sent him a rather cryptic reply. I told him that a true blue value investor will consider Zomato as a value sell and a momentum buy. Let me repeat that. For a dyed in the wool value investor, Zomato is a value sell and a momentum buy. Let's play a small game to understand this better. Now, if you have no other information, can you tell whether one should buy a stock priced at rupees 100 or the one priced at rupees 200? Next to impossible to pick the right stock, isn't it? Even if you manage to pick one over the other, you will be relying on luck and nothing else. Now let's change this equation a little bit. What if I tell you that the first one has a book value of rupees 150 while the second one had a book value or has a book value of rupees 180? Well, if the fundamentals of both the stocks are nearly the same, then the first stock should be preferred over the second one. This is because the first stock is trading at a discount of its, or rather a discount to its book value, while the second one trades at a premium. Thus, everything else remaining the same, the first stock has a better chance of going up and at least reaching its book value than the second one, which may even fall and go below book value. Well, this is nothing but value investing at work. Value investing is all about trying to figure out an approximate fair value of the company and then buying the stock at a small discount to this value to ensure a decent upside. It is not a perfect measure of value, but it certainly acts as an anchor and helps separate the price of a stock from its true value. The problem with book value, however, is that not all companies generate the same amount of profit on the book values. There are some that are more efficient than others, and hence book value may not be the right way to value more capital efficient companies. These companies can thus be valued using the earnings power method. But before we use earnings power, here's another small puzzle. Would you rather invest in a corporate bond of a company or its shares? Well, it depends, isn't it? If the bond is paying me 8% interest, then I'll at least need 12% from the shares because earnings of a company are more volatile than its interest payments. In other words, I will demand a higher return on my investment in shares than a bond of the same company. So when translated into the P ratio language, this means that while you're willing to assign a multiple of 12.5 times to the company's interest coupons, inverse of 8% is 12.5, you are assigning a P of only 8.3 times to the company's earnings per share. Inverse of 12% is 8.3. Thus, you will buy the company shares only if it is available at a PE of 8x or lower and would sell it at a PE of 12 to 13 times because at that multiple it will become less attractive than its bonds. So now if a company has average earnings per share or earnings power of rupees 100, you will buy the stock at rupees 800 or lower and sell it at rupees 1200 to rupees 1300 per share. Thus you are buying at a PE of 8 times 8x and selling at a PE of 12x to 13x. Now there are some companies, however, where you should not or where you should assign a P multiple that is much higher than 8 times. Why? Simply because these companies can grow their earnings power significantly higher than rupees 100 per share and thus bring about a significant increase in their fair value. What if the rupees 100 earnings power becomes rupees 200 in 3 years and rupees 400 in 6 years? In that case, a higher P multiple than 8 times is justified. But how much higher? Well, it is almost impossible to know in advance exactly how much the earnings of a company will grow in 6 to 7 years. Even the management of the company will be hard pressed to answer this, which is why a thumb rule of assigning a maximum P multiple works the best. A lot of value investors do not believe in paying more than 30 to 35 times for a company's earnings, no matter how bright the prospects. To them, this PE of 30 to 35 times is the boundary between investment and speculation. Anything inside this 30 to 35 PE is classified investment as per them, and anything outside of this zone is speculation. With that, let us go back to Zomato. Now, the stock currently trades at rupees 220 per share. The stock's book value per share, however, is around rupees 22 per share. This makes the stock 10 times more expensive than its latest book value per share. Therefore, it is far from being a value stock from a book value perspective. What about earnings power then? Well, Zomato recorded an EPS of rupees 0.75 per share for the trailing 12-month period. Now, assigning a maximum P multiple of 35 times gives us a value of around rupees 30 per share. Yes, that's right. The maximum value investor can pay for Zomato is rupees 30 per share. Anything more than that and he would be in the speculative zone. I'm sure you're wondering if a value investor can pay a maximum of rupees 30 or say even rupees 40 per share for Zomato. What explains the latter's huge premium? Why is it trading at a price of more than rupees 200 per share? Well, this is because some great things are expected of the stock in the future. It is expected to take a quantum leap in earnings and grow its earnings so fast that even a price of more than rupees 200 per share seems justified. However, a value investor is someone who does not believe in paying a huge premium for growth expected in the future. As per him, there are plenty of examples where investors ended up paying a big premium for future growth, but the growth never materialized. The eloquent Morgan Housel sums it up brilliantly when he says that every stock market valuation is a number from today multiplied by a story about tomorrow. Well, value investors don't believe in extremely fancy stories, no matter how believable they sound. Yes, they may buy the stock of Zomato as merely a speculation or a momentum play, but for Zomato to become a value stock with a sufficient margin of safety, it may have to correct a lot more than the correction it has seen recently. Until then, or until the profits grow a lot and the multiples become reasonable, Zomato may lie well outside a value investor's circle of competence. So what I have done is I have tried to view Zomato's valuations through the prism of value investing. It may not be perfect, but it does give you some idea about the risk and reward of investing in the company's share at its current price. And this is all one needs to do. Use a proven framework of investing and try and fit the valuation of the stock of his interest in this framework to analyze risk and reward. If the risks outweigh reward, you should not buy the stock, and if the rewards outweigh risks, you should go ahead and pull the trigger. This is all there is to it. That brings me to the end of this session. I'll see you again in the next one. Goodbye and happy investing.